Today, we begin our analysis with a major conversation dominating the crypto market, centered on new concerns surrounding Tether and USDT. Although overall news is quiet, the drama related to Tether has become the biggest storyline investors are debating today. Hayes posted that if Bitcoin or gold decline around 30%, Tether could face pressure on its reserve structure. As rate expectations shift downward, Tether appears to diversify into Bitcoin and gold to maintain profitability, increasing exposure to volatile assets. Hayes argues that a 30% drop in Bitcoin and gold would generate losses of nearly $6.8 billion for Tether. Because this loss amount is close to Tether's buffer, Hayes says such a decline could temporarily leave Tether under-collateralized.
Some argue Hayes is exaggerating, while others believe his concerns highlight real structural risks that should not be ignored.
It is important to clarify that the reserve report reflects Tether International, the entity backing USDT, not the broader Tether Group.
Tether Group reportedly earns over $10 billion a year from treasuries and holds more than $30 billion in corporate-level assets. To understand Hayes' reasoning deeply, we revisit the numbers he used to frame his argument regarding reserve vulnerability. Tether reports total assets of $181.2 billion and liabilities of $174.4 billion.
This leaves only a $6.78 billion capital cushion, which Hayes considers vulnerable to market volatility. Tether's allocation to gold, categorized under precious metals, is a key component of the $22.8 billion exposure.
Bitcoin makes up a significant share of the risky portion, increasing sensitivity to crypto market corrections. Even when USDC temporarily lost its peg, Tether maintained stability and processed billions in redemptions quickly and consistently. Still, the absence of complete detail regarding Tether Group's internal capital structure leaves some unanswered questions. Many observers argue that Tether should seek a full audit from a major firm to provide clarity, though this remains difficult in practice. Big Four accounting groups avoid clients with high regulatory and reputational risk, particularly those handling volatile digital assets. This makes it difficult for Tether to secure an audit even if it wants one, leaving the attestation model as its primary reporting method today. Understanding the difference between an attestation and a full audit is crucial for evaluating the accuracy of Tether's reported reserves. An attestation verifies balances at a single moment, while an audit thoroughly inspects transactions, risks, and controls across the entire period. Corporate-level income and equity could help stabilize the reserve during market downturns, though this is not part of the attestation report. History shows Tether has processed massive redemptions during major crises, suggesting strong operational liquidity. During the Luna collapse, Tether reportedly redeemed over $10 billion in a short time without denying customer withdrawals. This strong redemption record is often cited as evidence that Tether remains more resilient than critics suggest.
Still, transparency concerns persist because Tether is not a publicly listed company and does not share full financial details.
The attestation confirms reserve assets but does not disclose all corporate-level holdings, leaving part of the financial picture unclear.
Major auditing firms remain cautious due to regulatory, legal, and reputational risks tied to large crypto entities. This caution stems from past accounting scandals in traditional markets that continue to shape audit firm behavior today.
Events like the collapse of Arthur Andersen serve as reminders of the risks audit firms face when working with complex clients. As a result, Tether relies on BDO, a respected mid-tier firm, but this still leaves critics wanting deeper oversight. While Tether provides more data today than in earlier years, some investors argue the disclosures remain incomplete.
Despite the concerns raised, Tether's ability to withstand massive redemptions remains one of its strongest points.
Major stress events have seen the company process large withdrawals consistently, maintaining its one-to-one peg through volatility.
The bulk of Tether's reserves remain in U.S. Treasuries, which are considered among the safest financial instruments available. However, its allocations to Bitcoin and gold, while profitable recently, introduce variability not seen in purely cash-backed stablecoins. Volatility in these assets can shift reserve valuations rapidly, which becomes a focal point when critics discuss potential weaknesses.
Yet supporters argue the risk remains manageable,
due to the relatively small share these assets represent compared to total reserves. Corporate profits exceeding $10 billion annually may significantly offset any downturn in volatile assets held in reserves.
This equity base is often highlighted as an additional safety layer, even though it is not included in the attestation reports.
Investors rely on attestation reports and blockchain data, but still lack full insight into Tether's internal structures. Together, these strengths and risks create a nuanced landscape, making Tether neither perfectly safe nor critically endangered.
The truth lies somewhere between extremes, supported by strong fundamentals, but softened by areas lacking full transparency.
Investors should remain informed, watching Bitcoin, gold, interest rates, and regulatory developments that can all shift the stability equation.
This brings us near the conclusion of our analysis as we prepare to summarize the final lessons from today's complex Tether discussion.
As we enter the final segment, we review what this debate truly means for investors navigating the current crypto environment. These concerns highlight the balance between risk and trust, with transparency acting as the bridge connecting both sides.
Tether's peg has historically remained stable, but its reliance on volatile assets introduces some elements worth monitoring.
To form balanced views, investors should consider both the structural strengths and the legitimate questions raised by recent discussions.
Some believe the market is overreacting, while others think the concerns reveal deeper issues that deserve more transparency.
A reasonable conclusion is that Tether is not on the brink of collapse, but neither is it entirely without risk or criticism.
Corporate revenues and equity cushions provide added stability, though they are not fully visible in published reports.
Many exchanges rely heavily on USDT as core liquidity, making its stability vital for smooth trading across global markets.
Because of this central role, even small rumors about Tether can sometimes ripple into broader volatility across digital assets.
However, its long track record of meeting redemption demands continues to reinforce confidence for many large investors.
The main takeaways include acknowledging risks, recognizing strengths, and understanding the importance of transparency in evaluating stablecoins.
As we conclude, remember that continued monitoring of reserves, regulation, and market behavior remains essential.
Despite today's debate, nothing suggests immediate danger, but maintaining awareness helps investors stay prepared and informed.
Thank you for joining this analysis, and I hope the insights shared today help you navigate the evolving crypto market with confidence.